Matt Tucker, let's talk bond ETFs, and we'll start off with the TLT because that's where everyone's going nowadays. The 20-year plus iShares government Treasury Bond ETF's up 7% this year. How much higher can it go?
It's a great question, Greg. If you look at last year, it was up over 26%, 2014, another 7% this year. We've seen more than $1 billion come into that fund. I think we're in a world where global yields are falling, especially sovereign yields. 15% of global government bonds now have a negative yield. So if the long-term treasury at kind of a 220, 230 yield, doesn't look so bad.
And for a diversified approach, I know iShares is really getting the word out about its IUSB, which is a more diversified government bond ETF, right?
Yeah, it's actually, so it's investment grade, has some EM, has some high yield, has about 7% below investment grade. And we're seeing a lot of interest from folks who say, you know what, I want diversification, I still kind of want traditional core fixed income, but I need a little yield kicker. So it has about 30 basis points extra yield above a traditional, say, ag fund.
All right, we'll talk about high yield in a second. First, let's talk about munis because they also had a great year last year. You have the MUB. Do you stick with that?
Well, again, it's a search for income, right? On a tax-adjusted basis, for a lot of investors, MUB is yielding about 4%. And so if you look around the world and try to get 4% on anything in fixed income space, it's hard. So I still think that'll be a popular trade. Again, it has a lot of rate sensitivity. So if you did see rates back up, that's a fund that could get hurt. But given the trend we've been seeing, that's been a good place to be.
Well, people can get hurt stretching for yield. People worry about high yield, especially when energy fell over the course of the past few months, because there's a lot of energy issues in the high yield arena. Do you get back into high yield now?
Well, I think we're seeing, and it's interesting, we saw money has started to come back in. We've seen more than $1 billion come in just this year, 2015. I think we're seeing some investors who were kind of spooked by the collapse in oil and energy, but are starting to come back in. Again, it's a yield story. 5.5% you're earning on an HYG as an SEC yield. That's just really hard to come by in this market. Right?
And then finally, we don't talk about it often because people aren't seeing a lot of inflation. In fact, they're seeing a lot of deflation out there. But what about tips? Do they have a place in people's portfolio right now?
There's an argument to be made that you can get inflation protection cheap, given how badly the tips market has done, given what's happened to inflation. But if you look at the expectations, it's like a 1.6% inflation over the next 10 years, right? If you're optimistic and you think this global growth story is going to turn around, and we're going to see inflation pull back in, could be a good time to buy, but I'm just not sure we're there yet, right? Deflation is still the big worry and the big trend. Look at what the central banks are doing, in Europe and in Japan. They're injecting money into the market to try to lift up inflation, right? Until you see that take effect, it's hard to really like tips.
All right, thanks a lot, Matt.
Thank you, Greg.
Thank you for watching The Street.